Hi everyone and welcome to this video where we will discuss Learning Objective 2-3 where we will be describing the fundamental principle of performance and we will identify the major activities performed during an audit. So if you remember from the first video in this chapter, we were talking about the fundamental principles that underlie auditing standards. So there's three of them. Responsibilities. Responsibilities deal with whether or not the auditor is independent and capable of performing the audit work. Performance deals with the evidence that we gather and how we gather that evidence and how we document it to support our conclusions. And then reporting is about how we communicate the results of our audit procedures. In prior videos, we discussed these broadly, and then in the last video, we talked about the responsibilities principle. Here, we're talking about the performance principle. All right. The fundamental principle of performance is grounded in the auditor's responsibility to obtain reasonable assurance that financial statements are free from material misstatements, whether due to fraud or error. I think it's natural for people to think about when they in their mind when they're thinking about what auditors do. I think the first thing they always think of is auditors are out there to detect fraud, find fraud, uncover fraud. And fraud is actually, it's far more rare than you would expect. Really what the auditor is doing is documenting evidence that support the numbers in the financial statements. Now, sometimes the evidence suggests that the numbers in the financial statements are fraudulent, but in most cases, that is not what happens. So we're here to look and make sure that the financial statements are free from material misstatements, really due to error. Now, we do find fraud from time to time, but that's more rare than finding errors. Natural errors in the preparation, maybe reading generally accepted accounting principles in a way that's not consistent with what the goal of the standard is. All right, so what are the key elements of the performance principle? Well, the first is planning and supervision. So we have to plan the audit out based on risks, the risky areas in the audit, and then we have to supervise the people performing the audit. So the performance principle begins with thorough planning and supervision. Auditors must prepare a written audit plan, documenting the procedures that they plan to perform to gather sufficient, appropriate evidence. Planning involves obtaining and understanding a client's business and industry, which helps auditors identify potential risk areas, and supervision ensures that all audit team members work effectively and consistently with the established plan. So we are, in terms of the audit, the responsibilities principle was talking about the things you do when you decide to accept an engagement, when you decide to accept a client for audit work. Now we're talking about the planning phase. So what do we do in the planning phase? What exactly is that? And then you're also going to see, another key element in the performance principle is understanding what materiality is. So materiality is central to determining the scope of the audit. And if you remember, materiality deals with this idea that not everything is equally important when we, it would be good if I could spell, right? Materiality. Materiality, if we go back here, so materiality is the magnitude of an omission or misstatement in the financial statements that could influence the decisions of financial statement users. So the idea is that when we do audit work, we are not going to catch every mistake that there is in the financial statements. Our goal is to capture or find the mistakes and correct the mistakes that would affect somebody looking at the financial statements. If they were to look at the financial statements with the mistake in there, would they make a decision that is a bad decision? Would they end up using the financial statements that we've audited to make an investment decision, let's say, and that information was false, and so they make a bad decision about whether to invest or not? So as long as the amount of the mistake wouldn't affect an investment decision, we generally consider it what we call immaterial. It just means that it's not big enough to influence a decision that an investor is going to make. All right. So materiality is also important here when we talk about the performance of the audit. We're going to concentrate on the areas that have the highest risk in the financial statements and the areas that have the largest materiality. So risk assessment is also important here. So a critical part of the audit process is identifying and assessing the risks of material misstatement. This involves the understanding of the entity and its environment, including its internal controls. Based on this understanding, auditors evaluate inherent and control risks to determine the nature and the timing and the extent of audit procedures. So we're going to plan our audit, and we're going to choose to spend our time auditing, or more time auditing, the risky areas rather than the low risk areas. And then audit evidence is also important for performance. Auditors are required to gather sufficient and appropriate evidence to support their conclusions. Evidence must be both relevant and reliable to reduce detection risk effectively. This involves selecting audit procedures and evaluating their outcomes to substantiate the fairness of the financial statements. So the relationship between internal controls and risk assessment and the amount of evidence that we gather is kind of like an inverse relationship. The more effective a company's internal controls are, the lower we will assess risk, and the less audit evidence we will need to get comfortable and provide an opinion. So effective internal controls lowers control risks, which allows the auditor to evaluate less evidence and or do less audit work. Now, if you have a client that has controls over their financial reporting process and those controls are not operating effectively, they're not very good, then we are more concerned that those controls won't prevent a misstatement from making its way into the financial statements. So if we have an ineffective internal control environment, we're going to elevate our assessed risks, and we're going to have to perform more audit procedures. Our goal as an auditor is to provide reasonable assurance. So the concept of reasonable assurance underpins the performance principle. While it's not an absolute guarantee that the financial statements are free of misstatement, we can have a high level of confidence that they are free of material misstatements, so misstatements that would affect decision making. To express an opinion, the auditor obtains reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. To obtain reasonable assurance, which is a high but not absolute level of assurance, the auditor plans the work and properly supervises any assistance, determines and applies appropriate materiality levels or levels throughout the audit, identifies and assesses risk of material misstatement, whether due to fraud or error based on an understanding of the entity and its control environment, and obtains sufficient appropriate audit evidence about whether material misstatements exist. All right, so that's a mouthful there. But performance is about documenting evidence, and the amount of evidence we have to document is affected by how well the company's internal controls are operating. All right, well, that's it for this video. I appreciate you watching. Take care.